Hi guys, thanks for tuning in. This is my monetary policy vlog recorded here at the Study Center Gertsensee Home Office in Bern. My name is Fabio Canetg and I'm a PhD student at the University of Bern, where I have been working on monetary policy for almost 5 years now. Today I want to talk about an instrument that the ECB is using, the European Central Bank. It has been around for quite some time and it was changed just slightly 2 or 3 weeks ago when the ECB had its regular meeting. The instrument is called TLTRO or TLTRO. That's a targeted long-term refinancing operation that the ECB is conducting. Its main purpose is to provide liquidity to the banking sector. But in fact, it has two other goals that it is achieving. And I want to talk about these two goals because I believe they're unreported in the media. First one is there's an exemption threshold for commercial banks. That is, if you hold very little liquidity, then you don't pay any negative interest rates on your liquidity as a bank. So now what you can do is you go to the ECB and you ask them for a loan, a TLTRO loan, and the TLTRO loan would cost you only minus 0.75%. And you can just take up that money and leave it on your account at zero interest rates. So that's mainly Southern European banks who can do this because they're kind of short on liquidity relative to the Central European banks. Second goal that is underreported of this TLTRO program is that the interest rate wedge, even for Central European countries or banks, is negative. So that means that if you take up a loan at minus 0.75%, you can invest your money at the ECB at minus 0.5%. So that's basically a transfer to banks from the ECB for making loans to the real economy. So this is, in fact, it is helicopter money which is dropped over the banking system. So that was a very specific instrument the ECB is using. Check out my other videos, check out my Twitter account for any details on the Fed or the Swiss National Bank, and I'll be happy to welcome you again here.